Hey guys, welcome to today's show on Wealth Strategy Secrets. Today we're joined by Jeff Huston. Jeff is a business leader who understands the world of growing and protecting wealth. As a visionary, Jeff developed 3D Money with the investor in mind, drawing from his vast experience in the financial world. For 30 years, Jeff has owned and developed businesses from insurance and financial services to raising money from REIT investments to leasing companies and note offerings. In 2002, Jeff had a red letter day and was introduced to the world of alternative investments, and he hasn't looked back since. He has won several National Achievement Awards, has been a featured guest on podcasts, is a sought-after keynote speaker, and has presented at numerous conventions. Jeff is a Minnesota native who resides in a small countryside community with his wife, Carol. Together, they have 2 daughters and 6 granddaughters. Jeff and Carol play a vital role in the community and both actively serve at their local church. And Jeff holds his pilot's license and enjoys flying his small plane as much as possible. Jeff, so good to see you. Welcome.
Hey, good to see you, Dave. Thanks for having me on.
Yeah, no, awesome to have you here. Really looking forward to this conversation. And maybe we can get started with telling us a little bit about your background and your journey. How did it all start for you?
Yeah, I appreciate the question, and the introduction kind of told a little bit about it. I'll maybe fill in a few gaps without trying to be too repetitive, but I was a financial advisor. I started as a financial advisor in the mid-'80s and spent 25 years building a financial services practice. And if we have time, I'll get into that a little bit. Some of the details of why I transitioned out of it. But in 2010, I ended up selling my practice and was, mid to upper 40s at the time. And I sold my practice, so I had some money from that transaction. And I have a son-in-law who at the time was a youth pastor and really felt that God was calling him out of the ministry. He had been raised as a pastor's kid, and they kind of did what I'll call tent making, where as a pastor's kids growing up, his parents didn't make a lot of money, and so they would buy real estate, buy a fixer-upper home and fix it up and sell it, and that's how they subsidized their income. And so Gabe really had a lot of experience in everything from roofing to drywall to cement to plumbing, electrical, kind of the whole thing. And so he had a particular skill set in that world, and I had some money. And if you remember, in 2010, of course, the housing market was bad. Or it was good, depending upon your point of view. Yeah. And so we started buying real estate, some foreclosed houses in the downturn. Our initial goal was we wanted to buy 40 single family homes. And I put the money in, he put the work in, and we were just going to split the profits. And so we did that between 2010 and 2012. We bought our 40 houses. And then in 2012, we got the opportunity to purchase our first multifamily project. And we haven't looked back since. And so we really focused on the multifamily marketplace since then. We currently own about 1,000 units, and they're all located in Minnesota. We look for opportunities outside of Minnesota, but at this point, we haven't found any. We have another 300 or so that are under contract, so we continue to grow that part of our business. But when we transitioned from the houses to the multifamily, I was doing the houses with my own balance sheet, and but when I got into paying millions of dollars for these apartment complexes and doing significant renovations type of thing, we had the need for additional capital. And so we took a page out of my financial services background and retained securities counsel and began be the process of becoming a sponsor for our own Reg D private placement, or our own private placement. And so we have kind of two, well, I would say actually there's three divisions to our company. You have the asset management, which would be owning the real estate and managing the asset portfolio. You have the property management, which is, you know, renting the rooms, collecting the money, and maintaining the property. So that's the property management side. And then we have the capital side of it, which is what I work more in. Is the currently right now we have about 400 individual investors and about $90 million of investor money in our capital company that we use. Then we use that money to help us grow our other capital endeavors, our real estate capital endeavors.
Yeah, that's excellent. Let's talk about your red letter day, Jeff. I mean, a lot of the folks in our audience, you know, I think we were all, you know, brainwashed a bit, if you will, from, you know, Wall Street and corporate America, on just, you know, the safest thing you could do is just invest in stocks, bonds, and mutual funds. And really want to peel back the onion here and get your expertise from someone on the inside, you know, who was a financial planner, and how you transitioned to, you know, alternative investments. What was that red letter day for you?
Mm-hmm. Yeah, so a couple of red letter days that I'll point to. The first is, and maybe as way of context before we get into the content of the red letter day, the context is that when I started in the mid 80s, I didn't know anything about being a financial advisor. And so the way that business works is the financial institutions, they have training programs and they teach you how to do that. You know, as I have now, you know, 30 plus years of hindsight, or 30 plus years in the rearview mirror, I can see how it's, you know, it's a very agenda, they have an agenda, right? The thing that we have to realize is that everybody has an agenda, right? Your bank has an agenda, the mutual fund company has your broker has an agenda, everybody has an agenda. And I think people tend to say, well, hey, they know about this, and so I'm going to just, you know, trust my broker, or I'm going to trust my banker and let them tell me what the best thing to do is. The reality is that people have to have a certain amount of financial IQ themselves in order to successfully navigate. So I came from not knowing anything about it, being trained by the financial services companies. And in essence, what they told me in 1985 is that there are two places that your clients can put their money. Place now, but we'll call it two buckets. Bucket number one is the safe and secure bucket. So that would be like, you know, bank CDs or fixed annuities, fixed life insurance policies, things that don't have little or no risk to them of loss of principal. And then the other bucket is the risk bucket. That would be stocks, bonds, and mutual funds. And so for the first 15 years, I spent the majority of my time helping clients navigate the allocation of their assets between those two buckets. And then in 2001, I had one of those red letter days. And what happened is there was an individual or a representative from my broker dealer that I was representing at the time came into my office and introduced me to the world of alternative investments. And I was a little embarrassed, to be truthful, because I was a successful financial advisor. And I'd been a successful, you know, like performing in the top, you know, 5% of my peers for a long time, for over a decade. And I didn't even know what an alternative investment was. I'd never heard of it. No one had ever told me about it. And it was a little embarrassing, right? But I quickly saw how that could play a very important role in my clients' portfolios. And so I did about a year's worth of due diligence, to, hey, I don't want to just listen to the first guy that tells me about something and then dive in. So I did a year's worth of due diligence. And then between 2002, when my firm started offering alternative investments, from 2002 until 2010, when I sold the firm, we placed over $100 million of client money into various alternative investments. And I learned a lot in that time. I learned a lot about what's good, and there's a ton of good things about alternatives. And I learned some things that are not good. Probably the biggest disadvantage from my perspective, as from a financial advisor's perspective of an alternative investment, the biggest disadvantage is that it's an illiquid investment, right? And there's some very specific reasons of why it's an illiquid investment inside the securities code. But there is no secondary trading of this investment, which means that we tailored our investment as a 3-year offering. And so, and because I wanted to keep it shorter term because it's illiquid. But when somebody puts an investment in with us, they're stuck in it for a 3-year period of time. And then when that matures, then they can have a choice. I can get out or I can renew. But that's kind of probably the biggest disadvantage. I think the advantage, if I were to say, one big advantage is that it's Main Street investing directly in Main Street. So Main Street, it allows Main Street investors, an alternative investment allows Main Street investors to invest directly in Main Street business opportunity. See, typically what happens, Dave, is when the Main Street wants to do a business expansion. Tesla wants to build a new plant or something like that, right? Main Street wants to do an expansion. And they need money to do that. What they do is they go to Wall Street, and Wall Street packages this whole, offering thing, and then they take it to Main Street investors. And then Main Street investors put it in the capital opportunity, but it runs through the Wall Street middleman. And unfortunately, that middleman has a lot of penthouses and limousines and golden parachutes, and a lot of fraud that happens. In fact, I frequently have said it's the reason that I got out of the financial services business is because Wall Street is a rigged game. That's the other red letter day that I had, and just. There were a number of things that led me to get to the point where saying, hey, you know what, I want to make an exit from this kind of rigged game of Wall Street. But I'll tell you one quick story. So every year, every securities person who's licensed with FINRA, they have to take what's called, they used to call it an annual firm element. It's like a competency testing. I don't know if they still call it the same thing. But so I'm in Bloomington, Minnesota, taking my annual firm element. And there's a question on the test. Question on the test is this: true or false? Ethics is always changing. True or false? Ethics is always changing. So I answered false, right? Because, call me naive, but I think it was wrong yesterday.
Right.
It's still wrong today. And guess what? It's still going to be wrong tomorrow. That's just the way I think. Right. But in the Wall Street people, in their infinite wisdom, who put the test together, they don't see it that way. And I got the question wrong. The way they see it is ethics is always changing. It's a moving target. See, and that was like the straw that broke the camel's back, if you will. When I was a kid, there was a game. It was break the camel's back. It was like this plastic molded camel that was hinged in the middle. Right. And you'd put these straws in the saddle, each person would take turn and putting straws in the backpacks of the camel. And eventually there got enough weight, and then it would break the camel. That was the straw that broke the camel's back for me, that said, you know what, I need to make an exit. And so what I love about alternative investments is that it bypasses the Wall Street mechanism, middleman, if you will, and it allows Main Street investors to go directly to Main Street opportunity.
Yeah, a really great perspective there, Jeff. I mean, really someone who's seen it on the inside and made the transition in both worlds. And, I think for me, when I started this journey in 2000, it was really, I think it was really the entrepreneur in me that was trying to solve the problem of how can I really create true wealth? I wanted to create legacy wealth. And meeting with financial planners was always the same story. Every company I worked with, every advisor I worked with, it was the same story. And one of the big insights I got, first was really learning how money works, right, and understanding actually how money works. Understanding that things like taxes are your number one, biggest expense. Stock market losses, right? The periodic, right, compounding of increases, decreases, things over time is actually a huge killer, as well as qualified plans, right? So those are some of the biggest things prohibiting us from really achieving true wealth. And when you invest in an alternative investment, I really kind of call it the trifecta of investing, and which has become our investment thesis, in that, number one, you're investing in something directly so you get some tax efficiency. You're partnering with the government because you're providing housing by investing into real estate. You're investing in oil and gas, and you're providing, energy, right? So there's tax breaks to that. So whether the investment performs or not, you get the tax break, right out of the gate. Then we have predictable income, right, that comes from this through its cash flow. So that really reduces your risk by getting alternative streams of income. And then we're trying to force appreciation, like in those properties you talked about, or in different types of investments. You're driving value into that just as any business owner would, right? In creating value so that you can create a potential upside on the back end. So, I feel as if you can really, triple your money, right? Versus when you're just playing in that traditional market space and securities, you're only hoping that the market's going to go up.
Mm-hmm. Yeah. Yep. Agree. And I think you bring up some about the misnomers or the way people view money. And I think one of the biggest, I got asked recently by someone, what's the worst financial advice you ever have, anybody's ever gave you? And it's an interesting question, but my response was, when I was taught that money is math, and I think that's really bad advice, because money is not math. Math says that, well, let me give you an example. So let's say that you have Dave, you got 6 oranges in your kitchen, and you decided that you want to take the oranges out to your picnic table in the backyard. So you gather up all the oranges out there in your arms, and you take the 6 oranges and you go out to your picnic table, where you proceed to eat one of them, right? And then the phone rings, and so you get called away. So you had 6 oranges and you ate one. How many oranges do you have left?
5.
That's right. You got five oranges. That's the math, right? 6 minus 1 is you got 5 oranges. But what I'm going to tell you is the way money works, you don't have any oranges left, right? Because what I didn't tell you is we're going to put some time onto this story. And so you leave the oranges, you forget about the oranges, and you leave them there overnight, right? And so what happens overnight is that the neighborhood kid, he comes and steals 2 of them. There's 2 of them that rot, and the squirrels eat the other one, right? So in this story, the neighborhood kid that steals 2 is the government. He's stealing your tax. He's stealing your money from the taxes, right? He's eroding your from taxes. The 2 that rotted is inflation, right? Because the dollar keeps decreasing in value, and the one that the one that the squirrels eat, that's planned obsolescence. Right. So that's like your stuff is continually wearing out. Technology is wearing out. Your car is wearing out. And so people go into a fixed income. I saw it for years and years. They go, hey, Jeff, I'm going to retire. Hey, congratulations. And they lay out, we figured this out. We need this much to live. And this is how much we got coming in. And it all works. And it does work, for about 5 years or 10 at the most. Right. But then everything else, the world grows up around you. And all of a sudden that fixed income, you're stuck on this. And then how that turns out is, well, we're not going to go to Florida this year, or we're not going to trade cars anymore, or, so the travel decreases, the lifestyle starts to shrink. In my financial services business, we used to call that the Calcan curve. Right. And the idea is, as your money is deflating in value, you start spooning in early in your retirement, you start spooning in, a teaspoon of Calcan dog food, right, into your ground beef, so you can go full strength, right, when your money is depleted. And it's a brash statement to make.
Yeah. Yeah.
But it's that people are living that. And so we have to understand that money is not math. It's way more dynamic than that. Money is not, when I started as a financial advisor, they taught me needs analysis. That was kind of the precursor to financial planning. Needs analysis. So you enter all this. Well, Dave, how much are you going to need for retirement? What about college education for your kids? What about, and we plan all these events separately, and we plan them like it's a math equation. And then what we do is we stack that all together and bind it together in a real pretty booklet. And we give that to you, and you go home and you feel great. But, Dave, in 3 years, it isn't worth the paper it's printed on. Because why? Because there's all these eroding factors. The neighborhood kid, is, the government stealing your money with taxes, and the erosion is happening from inflation, because they're massive printing of money, and, planned obsolescence, all of that stuff. And it goes by the wayside because we think that money is math, but it's not. It's way more dynamic.
Yeah, really great analogy there, Jeff. And let's talk about that for a second, peel this back, right? Because it took me some time to really dispel this myth, but I believe that, traditional financial planning really advocates a nest egg accumulation theory, right? Where that you're going to build up a particular nest egg. So let's say, you build up a nest egg of 4 million, and you turn 65, and then you're going to run it through the Monte Carlo simulation, figure out, your lifespan. And, I know it's even less than this right now, but let's just say 4% a year. So you don't outlive your money. So now you're taking 4% on 4 million. So, you have an income of 160K, but take out taxes, inflation, some of those things you're talking about, it's probably more like maybe 110, that you're living on. And then each year you just keep knocking that back 4%, just keep taking that money out of your pot and just keep reducing it. So that's really what's advocated. However, I believe that when you invest in alternatives and you use a different strategy, which is actually completely contrarian. So it's building passive income, it's building asset values. And let's take that same scenario and say you had 4 million across, multifamily properties and some other alternative investments that were paying you 8% cash flow. You've actually doubled the amount that you're taking home each year. Likely it's much more tax efficient, right? Because you've been smart by investing in tax efficient alternatives. And then in addition to that, you're able to keep up with that, devaluation that you talked about, and the cost of living increases over time because your assets are actually increasing in value in addition to the cash flow that you're getting. And I think this is ultimately how, the ultra wealthy are really creating generational wealth.
Yeah, and so the idea that I think the mistake that a lot of times people make with their finances is they tend to think micro economically. In other words, I've got a guy that I work with at car insurance. I have somebody that has my health insurance, and then I got my retirement plan at work, and somebody there, and then I've got a banker and maybe a mortgage person or a real estate person. So I have all these different people. I have an attorney, I have an accountant, so I have all these different people, and we tend to compartmentalize our decisions financially and economically. But the reality is that we don't live, our financial life is not lived microeconomically. It's kind of like we could say, well, in life, I have different parts of my life. I have my faith, I have my family and relationships. I have career and education, I have health and fitness. So I've got these different quadrants in my life. And, somebody could say, well, hey, friends is friends, church is church, and business is business. Well, yeah, but that doesn't work that way, right? Because we're a whole person, right? You can't compartmentalize. I mean, we've all seen people who, let's say they have having marriage problems. And nobody who knows anybody who's either had marriage problems or who knows somebody who has had marriage problems, nobody would ever say that, well, you know what, it only affected, the relationship between spouses. No. I mean, it affected the other areas too. I mean, it affects, other relationships. Sometimes it affects their career. Certainly it affects them financially. Sometimes it even affects people health-wise, right? Enough stress and all of that. So, we're a whole person. Well, the same is true financially, Dave. Is that we're whole people financially. So microeconomics is like you're standing at the gas station, pumping gas, trying to figure out why in the world is it costing me so much, or you're chewing on a chicken leg, so thinking about, holy smokes, this chicken is expensive, right? That's microeconomics. Macroeconomics is harder though, because it's like a fish in water, right? Fish doesn't know he's in water because it's his environment. But I think it's really important for your listeners to realize that to be successful with finances, you have to be aware of what the macroeconomic trends are around us. There was the early 2000s when I first heard the term, "Don't fight the Fed." I had no idea what that meant. And then I started reading some books. I read G. Edward Griffith's book, Creature from Jekyll Island, or I read Richard Duncan's book, The Dollar Crisis. And it's like, holy smokes, there's more out here. There's a bigger environment that's happening. I'm just, I'm like the fish. I'm swimming in the water. I don't even know water exists. Right. But what I'm beginning to realize as I start looking at some of these other things is, I start becoming aware of my environment. And I started becoming aware that, hey, what did it mean in August 15th of 1971 when Richard Nixon went on national television and took the dollar off the gold standard? What did that mean for us economically? How did that affect the water around us, the environment around us? And, because that one decision is really what put us on a path where cash has become trash. And where physical hard assets can be a much better place economically, macroeconomically, because you have increasing asset values. You have, if you couple that with fixed debt, I know people who have, let's say 25 years ago, they bought a house and they financed it on a 30-year mortgage. And today their payment looks really small. Their payment looks really small today because inflation has worked in their favor. And so I think it's really important for us to recognize that it's important to look macroeconomically at things.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Right. I think trying to be on the right side of the equation in terms of macroeconomics and really, where is the puck heading in the future is really key. That's what savvy investors are doing. And I love to do that. It's part of our investment thesis as well. And really looking at, the supply demand imbalances. That's why multifamily has done so well in the past, decade, because of that imbalance in housing, in the demand that's needed. It's just not there. And now we're hitting the same exact thing, right, in the energy sector, where the demand continues to grow, and the supply is just not there. So the forecast is very imbalanced, which creates problems for some, but opportunities for others. So we definitely track those macro trends as well. Jeff, do you have a particular wealth strategy personally that you're focused on?
Yeah, I would say that hard assets, you really have to make a decision. Richard Duncan, in his book, The Dollar Crisis, he takes 350, 400 pages to talk about why the dollar and our, this paper currency is on a dangerous path. And so towards the end of the book, he says the demise of the dollar is imminent, and he's just taking the last 400 pages to lay out the case of why that statement is true. So he says, but the demise of the dollar is imminent. He says that fact is not in question. He said the question is, will it be death by fire or death by freezing? So death by fire is hyperinflation. Death by freezing is deflation. So then he finishes the book with a powerful statement. He says, fortunes will be made and lost on the answer to that question. So when I read that, it had a profound impact on me, because what I realized is that I have to make a choice. Because if I believe deflation or if I believe inflation, those strategies are polar opposite. So if I believe that it's going to be death by fire, which is inflation, then what that means is that I want hard assets. Cash is trash. I don't want cash laying around because it's getting worth less all the time. I want debt, right? And I want low interest, long-term debt, right? That's the story with what an inflation future. If I think it's deflation, the polar opposite is true, right? Because now I don't want hard assets because they're going down in value, right? I don't want debt because now I'm paying back debt with more expensive with more expensive dollars, or I should say I'm paying off my debt with dollars that have gone up in value, right? And so it's the polar opposite. Cash is king in a deflation story. So what I realized 20 some years ago is that I needed to make a choice. And And I just looked at the what I knew to be true. I looked at history a little bit, and I asked myself a couple of questions. Number one, do I think that politicians will ever do the fiscally responsible thing where we're going to balance the budget, we're going to tighten our belt, we're going to reduce, social programs, we're going to I think it was Thomas Jefferson that said a democracy will only survive until its people figure out that they can vote themselves entitlements, right? And so tell me that we're not there right now. And so that was the first thing. You say, no, you know what? I think the politicians are probably going to continue to be fiscally irresponsible, and they're going to continue to not be on a path of reducing expenses. And the second thing is, do I think the central banks will continue to print money or not? And, will they allow the currency to deflate in value? And, then you got people like Ben Bernanke, who, famously said that, hey, a motivated central government can always create inflation because they have at their disposal a printing press, or it's modern, or a computer key, it's modern, it's contemporary. And so he said, no, a central bank can always create. That was before he said that, when he was a professor. I mean, that was before he was ever chairman of the Federal Reserve. So I just looked at those things and I said, look, I'm going to play my game that this is going to be, and it's going to be death by fire. And so philosophically, that's where I believe. So I push. You take Dave Ramsey, Susie Orman, some of those, and I want to say I think those I have seen their advice do some really good things for certain people. It would not be the advice that I'm following, but I'm more of an active type of investor, right? And, I understand that, debt is a two-edged sword. I think it was Warren Buffett that said that debt accelerates returns and it also accelerates losses, right? It's like a hand grenade, right? You can either, use it to blow everybody else up, or you can blow yourself up, right? And so debt is something that you have to really understand if you're going to use it, that there's good debt and bad debt. And, good debt, very simply put, is good debt is outsourced to somebody else, meaning somebody else pays it. So when we buy an apartment complex and people pay us rent, that rental income is what makes our mortgage payment. So we have debt, but it's outsourced to somebody else that's paying it. That's good debt. Bad debt is that, I go on I want to go on a cruise and, and have a really fun time, but I don't have the money. So I put it on my credit card. And then when I get home, then I've got to, I got to work for the next 6 months to try to pay that off. That's bad debt. And so I think understanding how debt works, because ever since Richard Nixon took the dollar off the gold standard, our currency, this is the brain. I want to tell you, I still struggle getting my head around this concept. But what I'm going to say is true. But our debt, our currency, our dollar is debt. We think of it as asset. Hey, I got, $100,000, or I got $10,000 in my checking account. I got 10,000 in my checking account. Oh yeah, you know what? That's an asset. But what that asset is actually debt. It's actually a debt-backed asset. It's a debt-backed currency. And people say, oh, I want to pay off we should pay off the national debt. Hey, if we paid off the national debt, our economy would implode. It would fall apart. You can't pay off, because the actual currency, the dollar, is a debt instrument, and it's really hard to get our heads around that, because we got people. I was raised, hey, debt is bad. Get it all paid off. Don't have any debt. But if you can successfully outsource your debt to other people, so that other people are paying it, that's a really key wealth building factor.
Right. So where does that put you really tactically then, say, for portfolio allocation right now?
Yeah, so for me, I mean, I have some money in the market. I'm pretty cautious. I'm a little more internationally invested in with my market allocation. But you know, when I say I've got, is probably 10% of my total portfolio of my total assets are in the market, and 90% is real estate, farmland, apartment buildings, different real estate projects. I mean, but what you have to understand is you could look at that and say, you know, that's really foolish to not be diversified. But Warren Buffett famously said, diversification is for people who don't know what they're doing. Right. So there are people that should be diversified. If you're not a student of what you're investing, I happen to know real estate. I happen to be a student of real estate. I've got tens of thousands of hours of experience in investing in real estate. And so I'm very comfortable being heavily invested in my portfolio in real estate. And with real estate, comes the use of debt. So real estate is just well, there's real estate. There are those who would not call it an asset class, but for the sake of this discussion, we'll call it an asset class. But real estate has built more. Real estate has produced more millionaires than any asset class. Period. When I was a financial advisor, the people that I worked with that had money, they didn't make their money in the stock market. I can say without exception, they did not make that. Nobody that I worked with made their money in the stock market. They made their money one of two places. They either made their money in real estate or they made it in a business. You know, and I'll put under a business, maybe they got a big stock option, you know, thing, or there was a corporate, you know, a golden parachute or something like that, you know, but that was all, it was in business or it was in real estate. That's where the money came from. Now people store their wealth or a portion of their wealth in the markets, but generally they're making, and so I've just focused in my wealth building in the real estate sector. Because I like the idea of thinking in terms of there's tier 1, tier 2, and tier 3 wealth. You know, tier 1 wealth is, you know, the raw real estate. Tier 2 wealth would be, you know, like tier 1 wealth would be, yeah, you've got mineral rights, oil and gas rights, that type of thing. Tier 2 is you extract the product out, and now you're going to convert that to something. You're going to take the petroleum and you're going to convert it to aviation fuel, or, you know, anhydrous ammonia, or for farmers for fertilizer. You're going to get, that's tier 2 wealth. And then there's tier 3 wealth, which is really you know, that's the stock market. It's, you know, derivatives, right? Derivatives is a fancy way of just saying it's a derivative of something else. It comes from something else. And that's what really the whole stock market, mutual funds, stocks, bonds, all of that are simply derivatives of tier 1 and tier 2 wealth. So I just am focused my portfolio more in the tier 1 and tier 2 side of things.
Makes sense. And then I know you have some background in life insurance as well. And we've been a huge proponent of this strategy of using whole life for the infinite banking type strategy. So can you really comment on your, you know, philosophy around leveraging whole life?
Yeah, I think whole life this is one area where, let's say, what Dave Ramsey would say and what I would say, we diverge. But I think that permanent life insurance should be the foundation of every financial home, right? If you think of, you know, when you're going to build a financial home, when you're going to build a home, when you're going to build a physical home, what do? You know, you go and, well, first you get a plan together, but then once you start digging, you're going to dig a foundation, right? You're going to dig into the dirt, right? You're going to dig a foundation. And in your financial home, your foundation is basically asset protection, right? That would be things like protecting your assets, your car, your home, the physical assets. And then there's income protection, which would be, you know, some of your health insurance and disability insurance, life insurance, those types of things. So asset protection, income protection. That's the foundation of your financial home. And then when you get up, then you get up into the room. In this example, let's say there's 2 rooms in your house. You have your short-term savings, we'll say, you know, 5 years or less. And then you got long-term savings, which would be, you know, 5 years or more. And then the roof or the peak is really your risk investments. But what happens is we've kind of been conditioned by Wall Street and the financial institutions. We've been positioned to build our financial home the other way, you know, upside down.
Upside down,
right?
exactly.
And so when I say that, you know, permanent fixed whole life I own permanent fixed life insurance. I do infinite banking. I think it's a great strategy. Is that the only thing I do? No, but it was the first thing that I did. And I can tell you that as a financial advisor, you know, I sold a lot of financial products, but we always did use permanent fixed life insurance as the foundation in the household. And I can tell you when times got bad, so I went through, you know, farm crisis of the 80s, the stock market meltdown, 1988, tech boom and subsequent bust of the 90s, terrorist attacks 2001, the real estate boom and subsequent bust of 2008. You know, you got the pandemic. So I've seen these, you know, I've seen the gamut. And what I can tell you as a financial advisor is the people that had permanent fixed life insurance in their portfolio, that was the one thing that they weren't complaining about.
Yeah. Yeah.
You know, it's like just this mainstay, this anchor that, okay, you know what, the storms are raging all around me, right? But the anchor holds.
Yeah.
And
Yeah.
so yeah, it's a good financial tool. It's very misunderstood, Dave. Highly misunderstood.
Very misunderstood. Yeah, there's so much misunderstood about it out there.
If people really understood what that asset could do for them, they wouldn't be able to print enough of those policies. The insurance companies would have, the printing presses would be going nonstop because it's a really good product.
Yeah.
When you understand it and when you use it properly, it's a great asset.
Yeah, exactly. I think it's interesting, right? Because also, you know, we're conditioned to kind of looking at particular products, right? From Wall Street or wherever they come from, right? It's a product. So I want to solve this situation with one product. But when you really think about investing and really strategically, as you're kind of pointing out, a lot of these, you know, macro trends, the environment, all of these things going on, it's really more than just one product, right? You're looking at actually implementing a process, really, of how you're doing it. Because once you can kind of figure out this process, then it can be a rinse and repeat, and you can have, you know, you can have discipline over time, right? And you get that compounding effect. And another really beautiful thing about the life insurance is that, again, it's just very multidimensional in nature. So you're doing multiple things with $1. You're getting, you know, you're getting the life insurance benefits from that. It's in a tax-free shelter, compounding tax-free. You know, you can give it to your heirs tax-free. It has asset protection to it. I mean, there's just so many different dimensions of, you know, how you can leverage it. It's just very powerful. But I think, you know, typically we're just conditioned to think of things, you know, in a one-dimensional nature and say, oh, this has got, you know, what's the ROI on this? And, you know, I'm just going to look at it from that perspective.
Yeah, I mean, I've always looked at it as that there's an internal rate of return. That would be, what is the return on my cash value? All right. Then there's an external rate of return. And that would be, okay, if I take that money and I take it out of the policy, borrow it out of the policy, and I deploy that in another strategy, right, through the, you know, your terms, the infinite banking strategy, I'm being my own banker, right? That's an external rate of return. And then there's an eternal rate of return. And that would be like the return on the death benefit, right? So return to my estate or to my heirs, that's an eternal. So there's an internal rate of return. And here's the challenge. Most people, they only think, the Dave Ramseys of the world only think of life insurance, and they only measure it based on the internal rate of return, but they're missing two other massive opportunities for return.
Absolutely. Jeff, if you could give just one piece of advice to listeners about how they could accelerate their wealth journeys, what would it be?
Well, certainly education. As a financial advisor, I used to have people that would say, they'd make this presentation to them and they'd say, wow, you know what, Jeff, I trust you. Just do whatever you think is best. And when they would first say that, I didn't really know how to respond to it. After a few years, I kind of got a little perspective on my thinking, and my response would be, first, thank you, right? Thank you. I mean, literally, there is no greater compliment that you could say to me than that right there. But secondly, don't do that. Because I understand you might not love finances as much as I do. You might not love and be that interested in it. But we all have to have enough financial IQ that we're making decisions for ourselves. Because what I said earlier in our discussion is that you have to realize everybody in the world has an agenda. I have an agenda, Dave has an agenda, the oil and gas people have an agenda, your bank has an agenda, the mutual fund people, the insurance company, they all got agendas, right? You have to have an agenda. You have to have your own agenda. You got to play your own game. And my goal is as a leader of an organization, my goal is I want to be the dumbest person in the room. I mean, what I'm saying is I want to surround myself with people that are smarter than me. So I'm not saying that you should, hey, you got to know everything. You got to know how to allocate, and you got to understand insurance, and I'm not saying that at all. I'm saying you can surround yourself with really smart people. You got permission to be the dumbest person in the room, but you still got to have an agenda. Carol and I, my wife and I, we do quite a bit of coaching and mentoring to young couples. And a recurring theme for us is intentionality. Because people, by and large, today, I don't know if it was different years ago, but I'll say today, by and large, people are not intentional. Right? And I think it was Jim Rohn who said, if you don't have a plan for your life, there are plenty of other people who will have a plan for your life. And guess what they have planned for you? Not much. That was Jim Rohn that said that. And so, intentionality is important. Education is important. Play a game. Be smart. Be smart about this, because you need to have your own agenda, and you need to have enough thinking so that you can be the dumbest person in the room and still be coaching your team.
Excellent. I really appreciate that sentiment. Jeff, really appreciate you coming on the show today. I think we could go for hours on this topic, right? There's just so much to uncover here, and I know we're geeking out, but I know a lot of the audience is really going to love the value that you provided today. So really appreciate that. If folks wanted to reach out and learn more about what you're doing, connect with you, what's the best way to do so?
3dmoney.com is probably the best way to reach out to us. 3D Money, the number 3, the letter D as in David, the word money, 3dmoney.com.
Awesome. Thanks so much for coming on, Jeff. Really appreciate it.
Thank you, Dave. Appreciate the opportunity.